Welcome to this explainer. Take a quick look in your wallet right now. Chances are, there's a Visa logo staring right back at you. I mean, billions of us use Visa cards every single day, whether we're grabbing a morning coffee, booking a flight, or just ordering groceries online. But here is the absolute wildest part about this. Despite being one of the most recognized brands on the planet, almost nobody outside of Wall Street actually understands what this massive company does. Most people think Visa is a bank. Actually, it isn't. Sure, it evolved from the Bank Americard back in the 1950s, but today, Visa has transformed into something else entirely.
Which brings us to the trillion-dollar question. How does Visa actually make its money? To really understand one of the world's most profitable businesses, we have to completely shatter a very common illusion. Despite processing trillions of dollars in payments every single year, Visa does not lend money to consumers. No way. They don't issue credit cards, and they don't hold your deposits. Visa's true business is something completely different. They are the invisible infrastructure, the silent digital network that seamlessly connects banks, merchants, and consumers all across the globe.
Okay, let's dive into this. The real secret to Visa's incredible success is a business model known as a pure open-loop four-party payment network. Instead of taking on the massive financial headache and risk of lending, Visa simply built a highly scalable routing, authorization, and clearing framework. It's basically like a giant toll booth on the highway of global commerce. Think about it. When the economy takes a nosedive and a recession hits, traditional banks take a massive hit on consumer defaults. But Visa, the credit risk is absorbed entirely by the partner-issuing banks. Visa is completely insulated, meaning they just keep collecting their transaction tolls, rain or shine.
To really wrap our heads around the power of this open-loop system, we have to look at the sheer scale of their operation, and the numbers are just mind-blowing. During the fiscal year 2025, Visa processed an absolutely staggering 329 billion transactions. Let's break that down. We are talking about roughly 901 million transactions happening every single day. Every time you buy that coffee or tap your phone, you're one of those 901 million daily interactions relying on Visa's digital plumbing to move value from point A to point B.
And when you add up all those 329 billion individual swipes and taps, the financial volume is breathtaking. That daily activity resulted in $17 trillion flowing through Visa's asset-light pipeline over the course of the year. $17 trillion! Because Visa doesn't have to tie up its own capital to fund these purchases, this massive river of commerce drove a highly efficient $40 billion in net revenue for the company.
But here's the kicker. It's not just about how much revenue they make. It's how efficiently they turn that into pure profit. Because they operate a capital-light engine, their operational efficiency is practically unmatched. By the second quarter of 2024, Visa posted an astonishing 64.4% operating margin. Analysts consistently point out that this is one of the highest operating margins in the entire financial industry. To put that cash conversion engine into perspective, in fiscal year 2025, they generated $21.6 billion in free cash flow, while requiring only $1.5 billion in total capital expenditures to maintain the whole system. That is an unbelievable cash machine.
All right, Section 1. Decoding the transaction stack. So, how does Visa actually extract its wealth from a single swipe at your local store? Well, whenever you swipe, tap, or enter your card details online, an invisible mechanical process instantly springs to life. The merchant you are buying from pays an all-in processing fee, which typically ranges from 1.5% to 3.5% of your total purchase. But that fee doesn't just go to one place. It gets sliced up among the players in the network. The cardholder's issuing bank, the merchant's acquiring bank, and finally, Visa's payment network, sitting right there in the middle.
Now, you might assume Visa takes the biggest cut, but actually, the largest single component of that 1.5 to 3.5% cost is called the interchange fee. That money goes directly to the issuing bank to fund things like your credit card rewards and to cover their lending risk. Visa actually takes a microscopic cut called a network or scheme fee. For standard transactions, Visa retains just 0.13 to 0.15%. I know, it sounds tiny, right? But when you apply that tiny fraction of a percent to 901 million transactions a day, it absolutely compounds into billions of dollars in risk-free revenue.
Moving on to Section 2, the cross-border gold mine.
Now, what's really interesting about this is what happens when you travel or shop internationally. There's one specific type of transaction where Visa's margins become even more lucrative. Whenever the country of the cardholder's bank doesn't match the country of the merchant, Visa triggers a dual surcharge structure. First, there's the International Service Assessment, or ISA fee. This is a wholesale fee of 1.00% if it's settled in US dollars,
or 1.40% if a currency swap is required. But Visa doesn't stop there. They stack an additional international acquirer fee of 0.45% directly on top of that ISA fee. When you combine these stacked network tolls with standard international interchange rates, the cost for an international card transaction gets pushed up to between 2.5 and 3.0% of the purchase price. Because cross-border transactions require routing through Visa's specialized global rails, the company monetizes this geographic mismatch with exceptional profit margins. It literally makes international travel and cross-border e-commerce absolute revenue engines for them.
Which brings us to Section 3. Beyond plastic, tech, and security.
As digital commerce continues to explode globally, unfortunately, so does the risk of sophisticated payment fraud. With global e-commerce fraud projected to hit a staggering $43.6 billion by 2027, Visa realized they couldn't just rely on routing payments forever. To future-proof their network, they pivoted heavily into value-added services, or VAS. We're talking risk and security software, as well as strategic consulting. And it's working beautifully. In the second quarter of 2024, revenue from these value-added services surged to $3.3 billion. This non-transaction software now makes up a highly impressive 30% of Visa's total net revenue. They are monetizing the security of the network just as effectively as the transactions themselves. Right at the center of this new revenue stream are these incredible, real-time, artificial intelligence-powered risk engines. Platforms like Visa Advanced Authorization evaluate over 500 different risk attributes in literally milliseconds to flag fraud before a bank even approves the charge. Meanwhile, their token service replaces your sensitive 16-digit card number with a secure digital token. That alone has been shown to cut e-commerce fraud by up to 45%, while at the same time improving transaction approval rates by 9%. They even deploy AI to actively block automated credential testing attacks across the web in real time.
What's truly brilliant about this technology push is how Visa is decoupling its software from its own physical card rails. With the rise of instant open banking and account-to-account payments, Visa launched initiatives like Pay by Bank in the UK and Visa Protect for A2A. This basically allows Visa to license its cutting-edge AI fraud detection directly to non-card domestic payment networks. So, even when consumers bypass credit cards completely to pay directly from their bank accounts, Visa is still right there in the background, making money off the security of that money movement.
And finally, Section 4, the contrast, Visa versus American Express.
And this brilliantly illustrates the genius of their financial architecture when you compare them to a major competitor. Visa, alongside its primary rival Mastercard, operates an open-loop network. It gives them uncapped scalability and literally zero credit risk. American Express, on the other hand, operates a closed-loop model. They act as both the network and the issuing bank. This means Amex has to directly fund their card member loans, manage substantial provisions for credit losses, and maintain direct exposure to consumer defaults. When the economy dips and default rates rise, American Express feels direct balance sheet pressure. Visa? They simply rely on their partner banks to absorb all that pain, while they just keep happily collecting a fee on every single transaction.
Ultimately, the core takeaway of this explainer is this. Visa's true power lies in its position as the ultimate financial middleman. They've built this impenetrable moat precisely because they removed the heaviest burden of banking, the risk of lending. To quote the heart of the matter, Visa doesn't move money because it owns the money, it earns billions by owning the rails that allow money to move across the global economy. Thank you so much for joining us for this explainer. If you enjoy having business, finance, technology, and economics broken down in a simple, engaging way, please make sure to subscribe to Market Plainly. And we'd love to hear from you. Drop a comment below and let us know. Do you think Visa's greatest strength is its sprawling global network, its AI-driven technology, or its risk-free business model? Also, what company should we cover next? Speaking of which, now that you understand the invisible empire of Visa, you might be wondering about the other logo in your wallet. Be sure to tune in to our next Business Empires Explainer, Mastercard Explained, where we'll explore Visa's biggest rival and see how two companies built remarkably similar payment empires while fiercely competing for every transaction around the world. See you next time.